Interested in dividend investing, but impatient about the usual 2-decade wait for a satisfying cash flow? Perhaps you've considered fast-tracking with options like QYLD, but aren't exactly thrilled about diving into high-risk waters. Today I have some news for you, my Dividend and Conquer fam. Let's explore a dividend investment method that steers clear of QYLD and other high-yield covered call ETFs. The best part? This strategy allows you to relish the benefits of dividends in significantly less time and without the usual huge investment. Imagine having a goal to ditch the 9-to-5 and sustain your lifestyle with a yearly $50,000 from dividends. Sounds like a dream, right? But the numbers can sometimes be disheartening. For instance, to achieve this with Procter & Gamble, known by the ticker symbol PG, with its annual dividend rate of 3.48%, you'd need a whopping $2.3 million invested. Option for AVI, symbol ABBV, and it'd still require a solid $1.27 million. And these aren't even the high-risk options. So what's the magic formula that lets you relish dividends without breaking the bank? The answer lies in quality dividend stocks. Not the run-of-the-mill ones, but top-tier stocks that have a consistent history of increasing their dividend payouts for at least a decade. These stocks should have a payout ratio of less than 75% based on free cash flow and an annual dividend growth rate above 2%. For this illustration, I picked 7 such stocks. Verizon Communications, VZ, Walgreens Boots Alliance, WBA, Bristol-Myers Squibb, BMY, US Bancorp, USB, Johnson & Johnson, JNJ, Aflac Incorporated, AFL, and the Procter & Gamble Company, PG. Now, envisage having a $300,000 portfolio distributed equally among these stocks. With the dividends they yield, your annual dividend income would roughly be $9,625. You might be wondering, how do I bridge the gap to reach $50,000? Here's where things get intriguing: the strategy of covered call options. In the realm of options, you have a buyer and a seller. When you sell a covered call, you're essentially leveraging the stocks you own, promising to sell them at a predetermined price. If the stock price shoots beyond this, you'll have to part with your shares, but at a profit. If it doesn't, you keep the shares and the premium from selling the option. By doing this consistently every month, you could potentially amass a monthly income of about $3,602. Multiply that by 12, and you're looking at an additional annual income of $43,224. Combine this with the $9,625 from dividends, and voila! Your annual income from a $300,000 investment stands at a staggering $52,849. However, the world of options isn't without its pitfalls. Premiums fluctuate, and while the examples I used may sometimes appear conservative, remember that the stock market itself is volatile. This strategy might demand frequent monitoring, but once you get a grip, it's a monthly affair. There's also the tax consideration to keep in mind when selling options. The premiums will be taxable, and it's essential to consult with a financial advisor to comprehend the implications fully. Now, if you've been a follower of the Dividend and Conquer channel, you know we're all about maximizing our profits while minimizing our tax liabilities. To understand the impact of taxes on our strategies, let's consider the potential tax advantages and drawbacks. Using a strategy where dividends are taxed at the qualified dividend rate, often much lower than short-term capital gains, and option premiums are taxed, as short-term capital gains can lead to a higher blended tax rate than just relying on dividends. However, given the significantly higher income potential of this strategy, many investors find it worth the tax trade-off. Now, what if the market turns volatile? Well, volatility usually boosts option premiums. This is because the more uncertain the market is, the higher the perceived risk. And with higher risk comes higher premiums for option sellers. This means during market downturns or volatile periods, your potential income from selling covered call options could actually increase. One aspect we haven't touched upon yet is the psychological factor. Sticking to a strategy, especially when the market is behaving erratically, requires a level of mental fortitude. It's essential to remember your long-term goals and not get swayed by short-term market movements. The idea is to create a consistent income stream, and if you stay the course, this strategy can offer that. If you're finding this content valuable and you'd like to dive deeper into the world of dividends and innovative investment strategies, consider hitting that subscribe button. Join the Dividend and Conquer community, where we continually explore ways to optimize and expand your portfolio. Let's pivot a bit and talk about portfolio diversification. It's not enough to just pick any high-quality dividend stocks. Diversification across sectors is crucial. This ensures that if one sector faces challenges, other sectors in your portfolio can potentially offset those downturns. For example, while tech might be booming, consumer staples could be facing a downturn, and vice versa. Another thing to consider is the macroeconomic environment. Interest rates, inflation, and global economic events can impact stock prices and, by extension, option premiums. It's crucial to stay informed and sometimes adjust your strategy according to the broader economic landscape. Now, while we focused on covered calls, there are other strategies out there like cash-secured puts that can also be integrated into your portfolio strategy for additional income streams. However, like all investment strategies, it's vital to do thorough research or consult with a financial advisor before diving in. Beyond the immediate strategy, think about the ripple effect. As you earn more, you have more capital to reinvest. This can create a snowball effect, magnifying your income potential in the coming years. It's not just about the immediate returns, but also about setting up a foundation for future growth. Remember, the stock market is not just about capital appreciation. For many, it's a tool to generate consistent income, and with the strategies we've discussed today, you can potentially achieve that, even with a moderate-sized portfolio. Let's delve into the nuances of the stock market, specifically focusing on the strategies and considerations to bear in mind. Number 1. Market cycles and timing. Every investor should recognize that the stock market moves in cycles. There are bull markets, characterized by rising prices, and bear markets, marked by falling prices. Understanding where we might be in a cycle can help shape our investment decisions. However, it's crucial to remember that timing the market perfectly is nearly impossible. Instead, consider strategies like dollar-cost averaging, where investments are made at regular intervals, irrespective of market conditions. This reduces the impact of market volatility and helps in long-term wealth accumulation. Number 2. Research and analysis. Effective investment requires thorough research and analysis. While there's no shortage of data available today, knowing what to focus on is crucial. Fundamental analysis looks at a company's financial health, competitive position, and potential for growth. In contrast, technical analysis focuses on price patterns and market trends. Both approaches have their merits and can be used in tandem to make informed decisions. Number 3. Understanding costs. All investments come with associated costs, whether they're brokerage fees, fund management fees, or transaction costs. Always be clear about the expenses tied to any investment and consider them when calculating potential returns. Number 4. Long-term perspective. One of the most common pieces of advice given to new investors is to adopt a long-term perspective. While short-term trading can be profitable for some, for many, it leads to more losses than gains. A longer-term view allows investors to weather the inherent volatility of the stock market, with the hope that over time, their investments will yield positive returns. Number 5. Seeking expert advice. There's no harm in seeking advice. Financial advisors and experts can provide valuable insights, especially when you're unsure about specific investment decisions. They can guide you based on your financial goals, risk tolerance, and market outlook. However, always ensure that any advice you get is from a trusted and reputable source. Alright. Always ensure that any strategy you employ aligns with your financial goals, risk tolerance, and investment horizon. The beauty of the stock market is its versatility, offering multiple pathways to achieve one's financial goals. And as we conclude, if you found this content enriching and insightful, do give this video a thumbs up. And if you haven't already, subscribe to Dividend and Conquer for more such content, where our mission is to empower you with strategies to maximize your dividends and conquer the stock market. Question: what's the best piece of investment advice you've ever received or given? Share your insights in the comments below. We'd love to hear from you and learn from each other's experiences. Remember, we are not financial advisors, and the content presented in this video is for informational and educational purposes only. Always consult with a licensed financial professional before making any investment decisions. Thank you for diving deep into the world of stock market strategies with us. Investing is both a science and an art, and your insights and experiences enrich this journey for everyone. Stay tuned for more insightful discussions, and always remember, informed decisions lead to brighter financial futures. Until next time!